It's almost funny when he says we'll get rid of the IRS because we'll collect so much money from import taxes. Then a moment later, he says tariffs will make U.S. factories so strong that we won't need imports at all. If we stop imports, we lose tariff revenue. If factories replace every import, tariff income falls to zero. That shows how his ideas can contradict each other and make his plans hard to predict. When the real economy heats up, banks lend more. They don't move money from one account to another. They create new money when they make loans. If loans grow faster than payoffs, the total money supply rises. If payoffs outpace new loans, the money supply shrinks. Tracking money supply growth can help spot recessions, since lending usually falls when people worry about the future. During the global financial crisis, money supply growth flattened rather than dropped sharply. Today, growth has slowed from its long-term trend, but not yet declined. Still, many signs point to a weaker economy. We've triggered the SOM rule and seen the yield curve invert, then steepen. A steepening curve after inversion has predicted a recession about 90% of the time since the 1950s. These are odds, not guarantees. We live in a global economy where money, trade, and supply chains link countries tightly. Mike Maloney's research shows that when a major economy hits a recession, most others follow. In the 1970s, around 60% of countries fell into recession. During the 2008 crisis, nearly 100% did. If the US or China slows, many others will feel the impact. China is facing a real crisis now. It is battling the wrong kind of deflation, and its housing market is down 30 to 35%. 2 years ago, Chinese real estate was the world's largest asset class at about $60 trillion. A 30% drop wipes out $20 trillion in value. That loss cuts the buying power of the entire society and drags on economic growth. We must separate the stock market from the real economy. Lately, worse economic news has been good for stocks because it raises hopes for Fed rate cuts. This bad news is good news trade can push stocks higher even as factories slow, layoffs rise, and consumer confidence falls. It's not just China. India, Germany, the Eurozone, and Canada are all contracting. Japan's investors have watched the dollar double against the yen since 2014. Even after adjusting for Japanese inflation, the dollar's buying power has grown. If your expenses are in pesos, ringgit, or rupees, holding dollars can boost what you can buy when your local money weakens. Where do you park your savings? Many choose dollar-denominated assets. Some will buy Bitcoin or gold, but a large share of global capital flows into U.S. stocks and bonds. This flight to dollars shows how currencies and economies connect across borders. It also highlights why U.S. policy decisions matter to people everywhere. Economics feels complex because countless forces pull in different directions. Some push prices up, others push them down. Interest rates, yield curves, trade flows, and monetary policy all interact. Great investors thrive by spotting which force will dominate next, then positioning themselves to benefit while managing risk. Top investors share 3 traits. First, they master risk management. Avoiding big losses is their top goal. Second, they know their edge, what they understand better than others. Third, they make asymmetric bets, low downside, high upside. By focusing on these 3 skills, they can do well no matter how wild markets get. My friend Kenny follows these steps in real estate. He looks for multifamily deals where owners overpaid during the low-rate years of 2020 and 2021. Interest rates rose, rents didn't climb enough, and those projects struggled. Kenny buys them below construction cost. His downside risk is small, but his upside is huge if markets recover. That's an asymmetric bet. In times of crisis, emotions run high. People often act on fear or greed, not facts. When Russia invaded Ukraine, many cheered sanctions that later hurt Western economies more. They based decisions on emotion, not on a clear cost-benefit analysis. To succeed, you must think, not feel. Tariffs are a classic cost-benefit case. The idea is simple. Make imports more expensive so people buy US-made goods. That should boost factories, create jobs, and raise tariff revenue. In theory, higher wages and more production follow. In practice, tariffs often raise consumer prices and reduce the variety of goods available. He put tariffs in place, then paused them days later. If tariffs were supposed to make us rich, why pause them? This move suggests he knows tariffs hurt consumers and are more a negotiation tool than a path to prosperity. Walk through any big box store and you'll see most goods come from overseas. Do we have the factories, workers ready to make them here? Gen Z shows the challenge. Few young people want factory jobs. They dream of content creation, social media, or tech. Even if tariffs shift production back to the US, do we have enough workers willing to take those factory positions? If not, factories will stay idle or move elsewhere. True wealth is access to goods and services, not just income. $1 million means little if you can't buy food, medicine, or energy. Wealth is what you can use. On a desert island with coconuts, even a chest of cash won't help. When evaluating any policy, start by asking, will it increase the goods and services people can access? Ask whether tariffs will leave us with more or fewer goods and services in the short, mid, and long term. Honest answers usually point to fewer, even if some factories reopen. Tariffs shrink trade volumes, raise prices, and slow growth. The theory may promise high-paying jobs, but the net effect often hurts consumers more than it helps workers. He's a bull in a china shop. He pushes hard but often contradicts himself. One tweet threatens 100% tariffs on BRICS-linked countries, another praises Bitcoin. He warns against alternative currencies but supports digital coins that challenge the dollar. He wants a strong dollar for buying power but a weaker dollar for boosting exports. It's a confusing mix. Digital assets offer a new option. Bitcoin, Ethereum, and other coins aim to work outside the traditional monetary system. Some see them as a hedge against inflation or political risk, but crypto markets can swing wildly and many projects fail. If you invest, only use money you can afford to lose. Treat digital assets as part of a diversified plan, not a sure bet. Think of the yield curve like a roadmap. Normally, long-term bonds pay more interest than short-term ones. When short-term rates exceed long-term rates, it warns of a slowdown ahead. A steepening curve after that often means the road will get bumpy soon. Our reliance on global supply chains means that a factory shutdown in Taiwan or a shipping delay in the Suez Canal can cause shortages and price spikes. For example, the 2021 chip shortage slowed car production and raised vehicle prices by thousands of dollars. Consider different scenarios. What if inflation stays high? What if growth rebounds? Or what if a new crisis emerges? By planning for multiple outcomes, you avoid surprises and adjust your investments. As an individual, you can take simple steps to protect your money and your career. Keep an emergency fund with 3 to 6 months of living expenses in a safe account. Spread your investments across stocks, bonds, real estate, and perhaps a small portion of digital assets. Finally, invest in yourself. Learn new skills so you stay valuable if the job market shifts. The Federal Reserve watches jobs, inflation, and growth. If inflation stays high or unemployment falls too low, the Fed may raise rates to cool demand. If growth slows and jobs fall, it may cut rates to boost borrowing. These moves can affect loan rates, mortgages, and your savings. Right now, we face as many unknowns as we did in March 2020. Markets swing wildly. One day, stocks drop 600 points on tariff fears. The next day, they rebound when tariffs pause. We could end 2025 up or down, but volatility is almost certain. History shows that big policy shifts often lead to big market swings. To navigate this, focus on fundamental. First, manage risk. Protect your downside. That means setting stop-loss levels or using safer assets for part of your portfolio. Second, find your edge. Know where you have an information or skill advantage. Third, make asymmetric bets. Limit losses but leave room for big gains. If you stick to these principles, you'll handle whatever comes next. Above all, decide with logic, not emotion. Make a clear list of pros and cons for any policy or investment. Don't cherry-pick data to fit your beliefs. Instead, weigh every angle. That's how you stay ahead in a world of tariffs, rate moves, and global shifts. Stay curious and keep learning every day. Good luck, and thanks for tuning in.